Hi everyone, welcome to another video by you with Tutoring. I'm kind of get tired of saying that. I am Whitney. Yes, I am actually doing this video at night. That's weird. Anyway, I'm not gonna waste any time. I'm gonna get right into it. But before we do, reach out to us if you are not following us on Instagram as yet. Go ahead and follow. Like our content, subscribe if you aren't already doing so. Like, comment, share, and reach out to us. It's not too late. You can sign up still and get started on your tutoring journey. You need help, just sign up for the help. I mean, it'll be over before you know it. Might as well just make the best use of your experience, right? All right, let's pick up where we left off with our 2016 Principles of Accounts. Multiple choice paper. Here we go. Item 31 refers to the following extract from a trading account. So we have the opening inventory, sales, purchases, and closing inventory. What is our gross profit? How do we get gross profit? It is sales minus cost of goods sold. But we know that cost of goods sold never just always throw down there just like that. Like, hi, I'm cost of goods sold. It's not always there like that, right? But we can calculate it. So in this, what we're gonna do is opening inventory 200 plus our purchases of 500 minus our closing inventory of 300, and that would give us our cost of goods sold of $400. Subtract your cost of goods sold of 400 from your sales of $900, and you will get $500 as your gross profit. So that's C, guys. That's C. Item 32, where's that one? When a trial balance fails to agree, the difference is entered in definitely the suspense account. Suspense account, nothing else there, so don't make sense. How does an increase in bad debt affect a sole trader's financial statements? First of all, what is bad debt? What is it classified as? It is classified as an expense. What does expenses do to your financial statement, particularly your trading profit and loss account, which is also called your income statement? It decreases, right? So it decreases your profit. So your expenses decreases your net profit. It cannot be gross profit because we're dealing with the profit and loss section of the account. Oops. Sorry. Item 34. A debt is considered a bad debt if the debtor fails to pay. I have had some issues. I highlight everything except the correct answer for this one would highlight. So I'm just gonna write a little B right here so you guys can know. Hold on. It's not working out. You know, it worked out recently. All right, see it here. There you go. This answer is B if the debtor fails to pay. All right. What is the amount of insurance prepaid at the end of the year? Based on this, T account for insurance. Insurance is an expense. So expense account we're looking at, right? So we need to know the amount for insurance prepaid at the end of the year. You see the balance carried on right here? So it is our prepaid balance. So this balance carried on of 600 is gonna be our brought down of 600. It represents, this brought down will fall on the debit side of the insurance account, right? And this represents our prepayment. So the answer is 600. 600, guys. You know what? Moving on. It's A. M. Brown wishes to increase his provision for bad debts from 8% to 10%. Accounts receivable at the end of the year totaled $10,000, whilst the balance in the provision for bad debts account is presently $800. Which of the following would be the correct entries to record the provision for the year? All right. So we need to increase our provision. Listen, we're increasing our provision. Whenever we have an increase in provision, that's an increase in our expense. So that's an increase that will be reflected on our profit and loss account, which right away should be a debit, right? Because increase in provision, you would debit. What is a double entry when you're increasing provision for bad debts? You should know this. It's a debit to your profit and loss account and a credit to your provision for bad debts account. So the answer is, well, the answer cannot be C. C don't make sense at all. So we'll cross out C. just by that. Let's record the money. It is the amount that we increase by that we are going to be recording, right? So if you move from 8% to 10%, what's that change? See it here? At the end of the year, that is at 10,000. But the balance on the provision for bad debt account is presently $800, right? That's our current balance. So we can cross out B because we're not concerned with our current balance. We're concerned with the amount that it increases by. So it increases by 2% because if you leave from 8% to 10%, that's a 2% increase. So 2% of the debtor's amount, which is $10,000. 2% of $10,000 is $200. So we increase by 2%, which is equivalent to an increase of $200. And this is the amount that we'll record in our profit and loss account as a debit and in our provision for bad debt account as a credit entry. So our answer right here is none other than D. All right. I hope you guys are getting this. All right. Let's look at this one now. The cash book of Dan the Deer. All right. So what is the balance per bank statement? So you are given the balance per cash book. You're given total unpresented checks. You're also given lodgement not entered and on the bank statement, right? So what we do is we are going to use the balance as per cash book to reconcile. So we add unpresented checks. So we're starting with the balance. If you are starting with the balance as per cash book, listen which balance we're starting with, the balance as per cash book. You start with the balance as per cash book. We add our unpresented checks. So it's going to be a balance as per cash book, 560 plus unpresented checks, 120. And we subtract our late lodgements, which is 150. And the answer you get after doing that is D. So it's 560 plus 120 minus 150. Pay attention, we started with the balance per cash book. It matters which balance you start with. Trust me on that one. Go and review and you realize. In a partnership, which of the following transactions is compulsory? Which of the following transactions does have to take place in a partnership? You have to pay salaries? No, and all the partners receive salary, and all the time you have partners receiving salary. Interest on capital, interest on drawings? No. Sharing of profit and losses? Definitely. That's you have to share profit and losses. You think one partner can get all of the money? I think totally 3 partners can get all of the money? No. So the D is definitely our answer for this one. They usually give a profit and loss sharing ratio. If none is given, it should be shared 50-50. All right. The amount to be shown as a set off in the debtors ledger control account is, all right. So debtors with credit balances, we know that debtors naturally carry a debit balance because they're assets to us. But it is possible to have debtors on credit side as a credit balance. It would simply mean that we instead owe our debtors, right? Maybe it was some overpayment on the account, or maybe after the debtors paid, they end up returning some goods and we end up owing them something though. But the point is, when debtors present a credit balance, it means that we owe them instead. Similarly, creditors usually have a credit balance because they're liabilities. However, this is saying that creditors come with a debit balance. It just simply means that our creditors owe us instead of we owing them. It's like just the reverse of it. So that is possible. So set off, what is set off is basically like your customer, you have a relationship with a person or an entity where the person is also your customer as well as your supplier. So you have like have a transaction, something with someone, right? Like you buy something for someone, but so you owe, like you buy someone, you beg someone to buy something for you, right? So you owe the person. It came to $500. You owe the person $500, but you remember that the person also owed you maybe like $400 or $500. Same way, so you say, all right, let's just set it off. Let's just call it, balance it out right there, so you don't end up on pay with the person. Or if it is that you you owed the person $500, but the person owed you $400. You know, there's a net difference of $100, which will just work out. Anyways, the answer for this one I am going with is B. The amount to be recorded as set off in the debtor ledger control account. B. All right. Which of the following items can be used to adjust the cash book balance before preparing a bank reconciliation statement? All right. This one we're going. So what we're updating the cash book before we do the bank reconciliation. Usually on the bank reconciliation, just like the question up top right here, we usually have these two items, the unpresented checks and the late lodgements. So the answer for this one would be B, our direct transfers and dishonored checks. We usually use these to update our cash book. Because those are the items that we would found on the bank statement and use them to update the cash book. And then after updating the cash book, we go ahead and reconcile the statements. All right, on the 1st of June, P Park, a sole proprietor, owed creditors $4,300. During the month, he paid $13,100 by check, and at the end of the month, his balance owing was $2,700. Cash purchases for the month are $3,500. What is P Park's total purchases for the month? I mean, it's a mouthful, yes. By the time I reach the end of the question, I forget where it up at top. But let's go. So, in all creditors, $4,300. So during the month, he paid $13,100 by check. At the end of the month, what he owed was $2,700. We need to find total purchases. They gave us cash purchases. But before, to get total purchases, first of all, it is our total credit purchases plus our total cash purchases. We know the cash purchases, leave it one side. Let's work out the total credit purchases, right? So it's going to be the $13,100 minus the beginning $4,300. That's $8,800 plus the $2,700 owing at the end, which is $11,500 as our credit purchases. But the question asks us to find the total purchases. So you need to add the total credit purchases to your total cash purchases, which in this case is $3,500. And I'm getting a 15,000 answer right here, which is C. All right. Okay, awesome. Mr. Jones, all right, so Mr. Jones' business began the month with an overdraft of $1,200. During the month, total deposits were $2,000 and total payments were $600. What was the cash book balance at the end of the month? So an overdraft simply means you have a negative balance on your in your bank account, right? You're overdrawn, so you're with the bank, basically. That's a negative $1,200 you started off with. Total deposits of $200 were made. It's a deposit, we're getting money. We had to add the $2,000. Sorry if I said 200, it's 2,000. And total payments of $600. Payments, we lose money, you have to subtract the $600. So the balance that's left is a positive 200, which would indicate that it is a debit balance of $200. Mr. Smith does not keep proper records. He began his business with $10,000 in his bank account. He uses his vehicle and building worth $6,000 and $15,000 respectively as part of his business. Customers owe him $4,000. He withdrew $1,500 for personal use and owed creditors $2,000. What is the closing capital for the business? All right, so I'm going to put this accounting equation into play right here, where we're going to do assets minus liabilities to get a capital figure, which is not going to be our final answer, but let's start with it. So our total assets, what would be assets? The 10,000 in bank, that's asset. The 6,000, that's asset for his vehicle. The 15,000 for building, that's also asset. as well as the customers who owe him, because that's debtors. Debtors are assets. They added 4,000. Total assets, 35,000. Subtract liabilities. He owed creditors $2,000. That's liabilities. We end up with $33,000. No, that's not the answer. We also have right here where he withdrew $1,500 for personal use. That's drawings. And drawings, in previous questions up top, we indicated that drawings reduces our capital, right? So we have to subtract the drawings of $1,500, which would end up with $31,500 as C as our answer. To get the first part of this video, just watch part 1 and part 2 that were posted earlier. All right. At the end of the year, the capital of a business was $33,000. At the beginning of the year, the capital was $28,000. During the year, the owner withdrew $2,000 for personal use. What is the net profit? So we should know based on the balance sheet that our opening capital plus our net profit minus drawings gives us our closing capital. So it's just that we're going to just basically transpose, right? So we're going to say, all right, so our beginning capital is 28,000. So it would be our beginning capital of 28,000 plus our net profit, which is X, we don't know it, right? It's going to give us a figure we don't know as yet, minus our drawings of $2,000, and we should end up with $33,000. So we know that a figure that we don't know minus 2,000 should give us 33,000. So X minus 2,000 gives 33,000. How do we find X? It's going to simply be the 33,000 then plus the 2,000, which gives us $35,000, right? And then now we know that that 35,000 is the figure that we should get after we add opening capital and our net profit. So 28,000 of opening capital plus X, which is net profit that we don't know, should equal to $35,000. We need to find X as transpose. So it's going to be the 35,000 minus the 28,000, which gives us 7,000 as our net profit. And you can work it to see if the 28 plus the 7 minus the 2, keep about the 33. It should. And then the last question we'll look at in this video. What is the inventory at the end of January? All right. So we have cost of goods sold, beginning inventory purchases during the month. So we should know that our, what do we want? Inventory at the end. Okay. So we know that to get cost of goods sold, it is like our opening inventory plus purchases less our closing inventory. But we don't have closing inventory, so we're trying to find. So similarly, like I did up the top right there with the net profit question, we're just filling in, we're transposing, except this time we're not using a little section from the balance sheet. This section comes from the trading account, right? So we know the cost of goods sold already. And we know our opening inventory. I usually edit this thing, don't I? I don't know. I'm telling you guys, it's night. As I said, it's night. So I usually do this, don't I? Yeah. And we add the purchases. And then we would have less the closing inventory. And then this would have given the cost of goods sold. COGS. So we just transpose really. So this is $1,500. That's our purchases of how much? $1,200. Let's be closing. It's what we don't know. It's what we're trying to find, right? So let's call it X. And our cost of goods sold is equal to $1,400. 1,400. We have too much space here. All right, but up here, so this is our cost of goods available for resale. That's gonna be that's gonna be 2,700, right? 2,700, because when you add 1,500 plus 1,200, you get 2,700. So right here, 2,700 minus X should give us our cost of goods sold. So we're just gonna solve for X, right? Ooh, sorry. All right, so it's gonna be 2,700 minus the 1,400 should equal our X, and you should get $1,300 as your answer. And if you plug it in back, you're supposed to get the correct thing, because 1,500 plus 1,200 minus 1,300 should give you back the 1,400 as cost of goods sold. And that would be it, guys. Well, at least for now. I'll be back. Well, I hope you guys really learned something from this video. I hope it was helpful. And yeah, I can't promise I'll be back with a part four. Oh, but maybe might as well, right? I may just jump right into some next past paper questions. But until then, guys, don't forget to sign up for your tutoring journey to improve those performance, and all the best on your exams when they come. All right, I will see you guys next time. Bye-bye.